Hey everyone, welcome back to my channel. If you are building trading strategies or managing portfolios, you have probably wondered, how do I actually allocate weights to different stocks? Most people just split their money equally. 10 stocks, 10% each. That means if you have 1 lakh and if you are buying 10 stocks, maybe you put 10,000 in each stock. But what if there is a better way? In today's video, I am comparing 3 approaches: equal weighted portfolios, benchmark performance, and mathematically optimized portfolios using Python. We will see which one delivers the best risk-adjusted returns over a 10-year period using real Indian stock market data. So I am going to explain using the two files where I have the flowchart, how it is done, and then I have the actual code that I will execute step by step and show how the outputs are generating and explain the process as I go through this. So in this portfolio optimization, what we are going to do is we are going to pick stock universe. So these may be the stocks that you currently hold or you are planning to hold. So I have taken 10 top Indian stocks from Nifty 50 universe, but this can be any stocks or it can be any trading strategies. And then I am going to use the data from 2015 to 2025 for this optimization. And as a benchmark, I am going to use the Nifty 50 index. The symbol is NSEI in the Yahoo Finance where I will be downloading the data. So once I decided my factors or configuration, then next step is collecting the data. So this is where we are downloading the data from the Yahoo Finance, which is Y Finance, which has API to directly download data from Yahoo Finance. We will see the code. Instead of using the close prices, we are using adjusted close prices. The reason is that these prices have a continuous time series data. In general, the traded close prices have false drops. Means if there is a dividend or if there is a split, then the price actually can drop virtually, and the adjusted close price actually considers that and modifies it. So for trading strategies, optimization, backtesting, the adjusted close prices are better because the price series is continuous. Once we decided our data source and what we want to extract, then we create a portfolio data. Means for all 10 stocks we extract data as well as we extract Nifty 50 benchmark data. So let's go to the code now to see till this part. So on the left side I have the code, on the right side I am executing line by line where we can see the preview. So we have our standard data science libraries installed and loaded. We are going to use Y Finance library for data, and for optimization we are going to use the risk folio library. Instead of optimizing only the time series data or the prices, we are going to consider the factors. These are some of the standard factors that we are going to use from India factor library. These are not the price series, but these are academically researched and then agreed factors which we can use to build our strategies. So the warnings model is just to ignore the warnings. We are going to set theme of white grid for plotting, and then this is where the warnings are ignored. So once we have imported all the libraries, then next one is I am setting my symbols as top 10 stocks as I discussed before. So these are Reliance all the way up to ITC. So my symbols are now loaded. So these are the symbols that I set. I am appending NS for each stock. This is the format that Y Finance needs to download the data, and the benchmark index symbol. I'm going to start from 2015 January all the way up to 2025 June 30. The next step is to actually download the data. So I am combining Indian stocks plus benchmark. So this is where I have all the tickers from Reliance.ns all the way up to NSEI. Then using YF download function, I am downloading all the prices, 100% completed. If I look at the prices, it's a data frame starting from 2015 all the way up to 2025, and it has all the stocks, Bajaj Finance, Bharti Airtel, and their adjusted close prices. So next I am saving the portfolio prices into this variable and Nifty prices into the benchmark prices into Nifty prices. So if I look at this is all the portfolio prices. If I look at Nifty prices, I can see only the Nifty price starting at 2015 at 8,300 to 2025 at 25,000. So we have now our data downloaded and stored in these two variables. Let's look at what to do next. So to perform any optimization, we need to calculate the returns, which is nothing but the current day close price and the previous day close price, how much return we are making. So we are going to calculate daily returns. We are going to use the PCT change method that is available with Pandas. Once we have our daily returns, we are resampling it to monthly returns. So the reason we are doing this is the economic factors that we are going to use from India factor library. That is actually monthly data. So that's why we are converting our price data also to monthly data. So this is the monthly returns data. You can see this is for January, this is for February, this is for March, and these are the returns for Reliance, HDFC Bank, for benchmark, which is Nifty. These are the returns in January, February, March. So Nifty made 4.9% return in January. It made 0.4% return in February 2015. I think you got the idea. So once we have our monthly returns calculated, next step is to integrate them with the factors. So before we do that, let's look at the code. So we have our prices in these two variables. First, we are going to calculate daily returns for the price data using the PCT change method. If I show this is how it looks. This is a daily date, and then this is a daily return for all the stocks. The next step is to calculate monthly returns. If I show monthly returns, you can see January, February, March, and these are the returns for each stock. Similarly, we are going to store Nifty monthly returns in Nifty monthly variable. Once we have our price data for each month, so we are using the India factor library. Here we are using something called FF4, which is a standard notation in this library for extracting 4 key major factors agreed academically in literature. So here we are just accessing that factor returns. I will show what this factor returns means. So you can see for each month we have 4 values: MF, SMB, HML, WML. So these I will explain now quickly. So SMB is small minus big. So we take long positions in small size stocks, which is basically small cap, and then we take short positions in big stocks, which is large cap. So when we follow this strategy, we generate particular return, and then that is what we are getting in this data. For example, the SME value, when we follow the strategy in January month, we got minus 2.38 equivalent returns. These are not exactly returns, but these are the factors which represents that strategy. Similarly, we have HML, that means high minus low, which is basically when you take long positions in value stock and then take short positions in growth stocks, how it will look like. So we talked about SMB, HML, and WML, which is talking about winners minus losers. If you look here, we are taking long positions in winners and then we are shorting the losers. And MF is basically the market returns minus risk-free returns, which is basically how broad market index is behaving. So we are storing all the factors in factor returns, and then this step is just to align the data so that we don't have any mismatch between factor returns and then monthly returns of stocks as well as our benchmark. So once we make sure that our data is aligned, then next step is to perform the actual optimization. Here we are using the risk folio library as we imported. You can see we imported risk folio as RF. So that is where we are supplying our monthly returns of each stock that is stored in import. Then we are calculating statistics such as mu and covariance. I don't want to go into details that assume that these are statistics that are representing this returns monthly data. Similarly, we are adding our factors to port, and then we are calculating same statistics. Now our object is ready so that we can optimize it. Here we are using model, RM, object. These are kind of standard options most people use. We are optimizing the Sharpe ratio. I will talk what is the Sharpe ratio, but let me first run this code. Now we have completed our optimization and the weights are stored in W. So let's access them using W series. So you can see we got weights for each stock, which is maximizing the Sharpe ratio. So let me print it as the round values so that we can see clearly. So Reliance has 22% weightage, Bharti Airtel has 21% weightage, Bajaj Finance has 18%. So if you allocate capital in this manner, then we maximize the Sharpe ratio. Let me go back to my flow. We have stored our monthly returns of stocks as well as the Nifty, and then we download the factors, and then we align the time periods between the factors and the price series. So we have our data consistent. Then we used Riskfolio portfolio optimization tool, which is a standard tool which is used for asset allocation. So we have performed our statistics on this data, and then we added our risk, and then we performed optimization. Finally, we extracted optimal weights using the Sharpe ratio, which is maximizing the Sharpe ratio. And then, as you have seen, these are the weights that we have obtained for each of the 10 stocks. So far, if you didn't understand, it is okay. Once you see the results, maybe you connect better. So what I'm doing next with this data is I am comparing 3 portfolios. One is using the weights that we got just now from this optimum portfolio calculations. And the next portfolio type is we divide the money equally across all 10 stocks, which is basically 1/n allocation. Means if there is a 1 lakh, then 10,000 to each stock. And then we have our individual stock performance that also we will calculate. So under these 3 strategies, we are calculating our performance metrics. So one is the CAGR, which is nothing but compounded annual growth rate, which you all know very well. And we are also calculating annualized volatility, which is basically a measure of risk. So what is annualized volatility, which is nothing but standard deviation. Most of you may know if this is the mean return, then there is a 95% chance that your return may fall between mu minus 2 sigma to mu plus 2 sigma. So this sigma is nothing but our volatility. So that means if you are making 30% return and if volatility is 30%, then there is a 68% chance that your returns may be 0 or 60%. And then you have 95% chance that you may make minus 30% or you may make 90%. So that is the meaning of volatility. So your returns vary based on this standard deviation. And Sharpe ratio is standard word that is used across quantitative finance, which represents the risk adjusted returns. That means the CAGR is purely talking about return. Annualized volatility is purely talking about risk. So the Sharpe ratio is the ratio of this divided by this. So as you see the formula, this is the return and then this is the standard deviation. Constant risk-free rate, typically the fixed deposit return rate. So far we have calculated CAGR, volatility and Sharpe ratio. So let me go into the code to show how it is calculated. So now to calculate the portfolio returns, we know our weights are in W series. So these are the weights for each stock. And then the return, monthly return of each stock is in this data frame. So when we perform this operation, then we get our monthly return of combined portfolio. So this is basically calculating the weighted sum of the portfolio. So in this month, if you use these weights, you make basically 9.9% return. And in June, you make 4.4% return. So now we have our portfolio return stored in this variable. That is the first thing. This one, using optimum weights, we calculate our portfolio returns. Next one is calculating equated portfolio. So we are having 10 stocks, so N will be 10. And then the weight for each stock will be 1/10. And we are calculating the returns using the same formula. So here we are using equal weights instead of our optimized weights on the same price data. So now if you see with the equal weights in January, we are making 6.5%. Earlier we made 9.9%. Then we are also storing each stock monthly returns in this variable. So now we have our optimized portfolio returns, equated portfolio returns, and then individual stock returns. To calculate CAGR, I have defined this function. So this is basically taking the series, which is basically the price series, and dropping any NA values inside this price series. That means null values. Then assuming we have 1 rupee at the start and at the end, this is a standard function or way to calculate ending value. Once we have series like this, that means you just add 1 to each value in this series and then you calculate the product of that values. So that's how you get the end value. Then years is nothing but our ending date minus starting date divided by 365 days. So when you use this formula, you get your CAGR. And next function is for annualized volatility returns, which is nothing but you take the standard deviation of the series using the formula. You don't have to write, there is a standard function, and you multiply by square root of 12, which is basically for 12 months. Since these returns are monthly returns, if you want it for a year, then we have to multiply using this formula. And then Sharpe ratio is nothing but CAGR by volatility, which is nothing but this value divided by this value. And then we are calculating CAGR for optimum portfolio, equated portfolio, and benchmark, and then individual stocks. So now we have our CAGR values. Similarly, we are calculating volatility for all 4 strategies. Then we are calculating Sharpe ratio for all 4. So finally, we are having CAGR, volatility, and Sharpe for each of them. So the 3 you can see here: optimum portfolio, equated, individual stocks, and fourth one is benchmark. And then we have calculated all 3 for all 4 of them. And then finally, we have to create comparison table and format it for visualization. So here I am just storing into the data frame which has all the values. So it looks like this. But before going to the discussion, let me format it. Basically here I am just formatting with percentage for these 2 and then Sharpe ratio, leaving it as it is. Then this is how it looks after that. So you can see equated portfolio made 19% CAGR over 10 years with a volatility of 16%. You can think of volatility as risk, as we discussed, and Sharpe ratio is ratio of this by this. So we got 1.18. Similarly, we have for optimal, benchmark, and then single stock. So I will explain towards the end how to interpret this table, but since we maximized our Sharpe ratio, you can see 1.3 is the highest for our optimal weighted portfolio. Next, to create the charts, I'm going to store all the stocks in this independent table. For each stock, what is the CAGR, volatility, and Sharpe ratio. You can see the Bajaj Finance made 37% CAGR, but having risk of 40%. So Sharpe ratio is 0.93. As you can see, any stock and every stock is not exceeding Sharpe ratio of 1 here. Whereas our optimum portfolio, it has a 1.37 Sharpe ratio. So now let's plot the charts. So I have calculated using this return series what would be the equity curve. I'm just going to plot it. So this is how it's going to look like. So the green line is Nifty 50 benchmark. So if you start at 1 rupee at 2015, you will have roughly 3 rupees at 2025. That is like 200% return. And if you go with equal weight, that means if you buy these 10 stocks and allocate 10% weight to each stock, that means if you have 1 lakh, then you are allocating 10,000 to each stock. Then this is how your return is going to look like. And if you are using the optimum weights that we calculated just now, then you are going to do something like this. So 1 rupee would have become 9 rupees, which is like 800% return. And then let's see the pie charts of how our allocation is happening. So in equal weight portfolio, you have 10% allocation to each stock, and then that return you are seeing in this blue line. And then in our calculated optimum portfolio, you are allocating 21% to Reliance, Bajaj Finance 17%, Infi 15%, Hindustan Unilever 17%. So basically, if you have 1 lakh, you are putting 21,000 on Reliance, 17,000 on Bajaj Finance, 20,000 on Bharti Airtel. So once you do that, you get this orange line. So now I am completing my code tutorial. If anyone of you want code, then you can check out the link in the description to get this code. But let me move towards the conclusions. So as you have seen, we have plotted the growth chart of each strategy. Clearly the optimum strategy is performing better. So the blue line is with equal weight, and then with optimal weights, we are getting the orange line. And to summarize, we are making 23% return with optimum weights and risk is 17%. So our Sharpe ratio is 1.37, which is the ratio of this divided by this. And if you put all your money in single stocks, best stocks, we don't know upfront what that stock going to be, but hypothetically, if you had a time machine and if you know what is the best stock, then you would be making 37% return instead of 23. But the risk is 40% on that single stock if you put full money. So your Sharpe ratio is 0.93. So in a way, Nifty 50 is making 11.3% with a risk of 16%, and our optimum portfolio with 10 stocks with optimal weights is making 23%, which is better than equi-weight, slightly higher volatility, but better Sharpe ratio overall compared to equi-weighted. And this is better Sharpe ratio than among other two as well. So the conclusion is that by using the optimum weight, you will increase your returns by minimizing your risk or keeping the risk same, so that you are maximizing your return for the same risk that you are taking in the equity market. So you should never put in a single stock. As you can see, the volatility is very high for single stocks. So in short, this you can apply to trading strategies as well. For example, if you have 10 trading strategies where you are doing algorithmic trading, then you don't know how much capital to allocate for each strategy. Then you can use this to allocate money to minimize your risk and then maximize your returns. So basically, you are optimizing for risk adjusted returns, which is nothing but Sharpe ratio. So that's all for today's video. I hope you got good overview of how you can optimize how much capital to allocate to each stock or each trading strategy. If you have any questions, do let me know in the comments, and also let me know what content you want to see more from quantitative finance, backtested trading strategies, algo trading, AI applications in finance and trading. All right, see you in next video. Thanks for watching.